Hi, my name is Isaac Hentel, and I'm with Brianna Djonovic and Jeremiah Keating, and this is our Finance 320 portfolio project. So the stocks that we chose to add to our ETF were Johnson & Johnson, Disney, Netflix, Tesla, and Shell. And you can go to the next slide. And we chose each of these stocks for different reasons. Johnson & Johnson being a leader in the pharmaceutical industry. They're always putting out new therapies, and we're one of the main COVID vaccine competitors. We chose Disney because Disney's always been a powerhouse. And with Disney Plus taking over the streaming market, beating all predictions and odds, as well as the old CEO of Disney came back, being replaced after the current CEO got fired, which was actually chosen by the former CEO of Disney. We chose. We can just go to the next slide.
Yep.
We chose Netflix because Netflix is the leading above Disney Plus. It's still the leading streaming service, and it's interesting because they reported a loss of their subscribers to their platform for the first time in 10 years. And so it'll be interesting to see if there's been any trends that led up to that we can notice. Tesla, Elon Musk has recently bought Twitter, which has caused a lot of controversy, and a lot of people are like losing loyalty to him as a person. However, they are expanding their cars into Asian markets, so it's interesting to see how that one turns out. And lastly, we chose Shell. Shell is one of the leading oil companies, and as much as electric taking over the market, oil isn't going anywhere anytime fast. So
The performance of our fund showed that our percentage return over the 5-year period was 19.85%, while the S&P's percentage return was 10.18%. So overall, we had a positive return, and our return performed over 10 percentage points better than the S&P 500 over the 5 years. From the table, you can see that Johnson & Johnson has a beta of 0.56, Disney at 1.21, Netflix at 1.17, Tesla 1.89, and Shell of 0.68, with the whole portfolio's beta being 1.1. So based on this beta calculation, our fund was more risky than the S&P 500, and it indicates that our returns were slightly more volatile than the S&P 500, leaving us with a more aggressive portfolio. And Disney and Netflix and Tesla had the highest betas over 1. The Sharpe ratio was 2.635, so it was much greater than the Sharpe ratio of the S&P 500, which was negative 0.53 over the 5 years. And this indicates that our portfolio has a much higher risk to return ratio than the overall market. Jensen's alpha was extremely high at 8.93%, and based on this alpha, our fund highly outperformed the market, and it's indicating a abnormal amount of return with the risk of the assets in our portfolio.
One of the main stocks that contributed to the growth in our portfolio was Tesla, as starting at 23.62 and then increased all the way to 182.45. This makes sense. Tesla at the beginning of the calculations was a very high growth stock and relatively young in its formation. And we saw a lot of growth over the 5 years in that stock. Most of the rest of the portfolio had relatively modest returns. Johnson & Johnson and Shell even had negative returns, but because of the explosive hike in the stock price in Tesla, it balanced out our portfolio and even added some significant growth. Another very important part of our portfolio is the diversification. These 5 stocks all came from a different sector of the economy, and this is the main reason that we were able to keep our beta so low, 1.1, which is not very much higher than the normal S&P, which has a beta of 1. And then here is our sources from which we got all of our data.